let's just start with your base case. What is it?
Yeah, so John, I think you could see some transitory factors pushing inflation higher here over the short term. But in our view, inflationary pressure should actually remain fairly contained. There's a huge amount of slack still in the labor market. There's big secular trends around technology, around globalization that we think should keep a lid on inflation over the longer term. And that's one reason that we're comfortable continuing to own bonds here as the ballast of a portfolio. But of course, there's areas of the equity markets that certainly you want to be embracing and having exposure to as we do start to see this reflationary trade taking off in pockets. I think selecting the areas of a portfolio where you want to have offense is really important now, as some parts of the market have really just been flying. You look at small cap equities, and Abigail talked about this in the introduction. In the fourth quarter, they were up 30%. They're up another 16% year to date. I mean, that is just unbelievable to watch. So there's other areas that we think offer a better trade-off in terms of risk and return.
I'm familiar with your thinking, so let's build on a little bit of it, Emily. The theme seems to be balance and how you achieve that balance. So you're keeping that bond market balance, that duration, without much fear about reflation, but in the equity market, anchoring yourself just a little bit to that cyclical upside in the United States. Can you tell me the pockets of the stock market that you're leaning into?
Sure. So it's really right now about owning the U.S. over non-U.S. equities. And what we're seeing is really this multi-speed economic backdrop playing out, where U.S. economic growth is measured by things like PMIs, continues to accelerate, while the rest of the world is sort of moving in the other direction, particularly in Europe, where it does look like there is a risk of a double dip recession starting to play out. So if you're going to embrace cyclicality, we think the way to do that is in the U.S., and it's by topping off allocations to value, by looking to go down in market cap. In particular, we see mid-cap equities as really the sweet spot as far as adding that element of participation to a portfolio. And we see that the negative interest rate environment overseas is going to be a big challenge for international equities, particularly as they have a big slug in the financial sector. So we think U.S. banks over international is really the way to go here in terms of adding that participation to a portfolio.
How does the dollar call, Emily, for you and the team over at John Hancock line up with what you're talking about in equities?
And this is probably the thing that we're watching the most right now, as the dollar is clearly hitting an important inflection point here, having fallen close to its early 2008 levels. And if you remember, the story from the beginning of 2017 into the beginning of 2018 was one of global synchronized growth. And you saw the dollar weakening as a result of that, as other more risk-on currencies caught a bid. And we're kind of at the same intersection now today. If we're right and this multi-speed environment plays out, that should ultimately create a bid for the dollar. But of course, there's some powerful forces right now that are continuing to put downward pressure on the dollar, particularly the prospects for more fiscal stimulus. So I think it's a really tough call right now to make, but the implications across multi-asset investing here are huge as we head into the remainder of 2021.
So go back to that theme of balance in the portfolio, Emily. If that's the risk, how do I want to balance that risk in the portfolio? If I'm thinking about potentially a dollar breaking out, I'm thinking about maybe this rally in commodities breaking down. Do you think the reduction in your cyclical exposure internationally helps you manage that just a little bit?
Exactly. And I think, again, looking to areas of the growth side of the house, even though we want to own some value, that doesn't mean that you want to abandon the growth side of a portfolio. So perhaps if this reflationary trade takes a break, and I certainly think that the dollar continuing to appreciate here would be one element of that story, you want to make sure that you continue to have parts of the portfolio that can do well based on strong fundamentals, not just this riding this cyclical wave. So for us, that means continuing to own quality, particularly in the U.S., and also internationally, having a tilt towards growth over value in order to kind of contain some of that more economically sensitive exposure. We're just not ready to go all in on that yet.